Hello learners, I am Dr. Nidhi Mathur, PhD in Public Administration and teaching at Institute of Management Technology, Center for Distance Learning, Ghaziabad. The subject expert is Dr. Neeti Mathur, teaching in National Law University, Jodhpur, Rajasthan. In the previous session, we discussed the topic Exchange Risk Management. Today, we are going to talk about Basics of International Investment in detail. In simple words, investment is an act of allocating resources, mostly money, or owning an asset or item with the expectation of generating an income, profit, positive benefit or return in future. Now, international investments, as the name suggests, are the investments that are made outside the domestic markets, which offers diversification in portfolio and provides opportunities to minimize risks associated with investing. International investments helps in expanding the horizon of returns by broadening the portfolio and serves as a medium for adding financial instruments to the list of investments, overcoming the limitations in variety of domestic markets. The variety of combinations of equity and debt instruments which are traded in various parts of the world outside the domestic markets are made available to an investor through the concept of international investing. Geographically diverse portfolio enables contrasting the domestic investing with international investing. International investments enables investors to capitalize on the performance of foreign economy by using various financial instruments such as shares, mutual funds, currency pairs or forex, etc. Understanding international investing. A broad investment universe for selecting a portfolio is provided to investors via international investing concept, which adds new sources of return potentially by broadening the diversification of an investor. Mitigating the systematic risks that are associated with the economy of any specific country is another role played by international investments. The eligible instruments for an investment beyond domestic investments are generally expanded by investing internationally. Similar types of financial instruments are available internationally as available in domestic investments such as stocks, bonds, mutual funds and even index derivatives such as futures and options on underlying currencies and international investments. In international markets, an array of investment options can be found by investors. A basis for international investing is provided by looking to government debt and international equity. Considering a comprehensive view of international investments, numerous variations of stocks, bonds, mutual funds, etc. are available for investors. To help funding the financial budgets, debt is issued by governments across the globe, which is termed as international government debt. It is issued in the form of bonds and notes ranging in maturity, and the underlying investment span derives their interest rates. To understand different countries' economies and risks, they can be classified as emerging and developed, where developed countries have more conservative risks, being the most advanced economies, and more opportunity is offered by frontier markets or emerging countries as they develop over time. To understand and determine the risk involved in a fixed income investments, an investor can refer to credit market ratings. Credit ratings are received by different countries from credit rating agencies globally in a form of comprehensive list available online for free. A basis for international investing is provided by a wide range of international indexes in the equity markets. Investors can look into world indexes of all countries for thorough exposure in global market, which includes stocks from various countries in the world. Global equity markets are classified into three categories: developed, emerging, and frontier market indexes. Typically, due to advanced market infrastructures and corporate markets, the lowest risk is offered in developed markets equities, while emerging and frontier markets have higher risks. International investors still demand more for emerging markets even after having high risks, as they also offer high returns with great potential. One of the well-known international index provider is MSCI. Let us now discuss about types of international investments. The various classifications of international investments are as follows. Number 1, Foreign Portfolio Investments or FPI. It refers to the investor's interest for investing in foreign companies where an investor may not have a long-term interest, but through exchanges they can trade them easily. Here, an investor invests into stocks, bonds, or assets of a company, but the purpose is to achieve a good financial rate return and to diversify the portfolio in multiple markets, and there is no purpose for controlling or directing the operations of management of the company. Number 2, Foreign Direct Investment or FDI. It refers to the interest of foreign multinational companies to invest in an economy. Here, the intent of an investor is to invest or acquire foreign assets with the purpose of controlling and managing them. FDI is a long-term investment strategy, and there are multiple ways through which companies can make an FDI, which includes purchasing assets, investing in the company or new property, equipments or plants. Also, if the technical know-how of capital is in place, investment can be done by initiating a joint venture along with a foreign company. The investments coming into the country by a foreign company is termed as inward FDI, and investments made by companies of a given country into foreign companies of another country. It is termed as outward FDI. Net FDI inflow is calculated through the difference between inward and outward FDI, and it can be both positive and negative. Number 3, government funds and aids. These transactions refers to the ones carried out between the governments of two countries where the purpose of funds or aids is to assist the entire economy. Number 4, cross-border loans. It refers to the arrangement of loan by the government of a country in which loan financing is done by a foreign bank or institution. Due to its easy accessibility and very few collateral restrictions, cross-border loan financing has become very popular financing vehicle. In case of long-term interest, FDIs and FPIs have no major difference. However, FDIs may look for ownership and voting rights provisions. In recent years, cross-border financing have been outplayed by FPIs and FDIs with the increase in global reach and technological advances. Types of financial instruments. A real or a virtual document that represents an agreement which is legal in nature and involves any type of monetary value is known as a financial instrument. Any asset or a package of capital that can be traded is considered as a financial instrument. Providing flow and transfer of capital efficiently to investors throughout the world is an important role of a financial instrument. Financial instruments are generally classified as number 1, cash instruments. If the value of a financial instrument is determined and influenced directly by the markets, they are known as cash instruments. Easily transferable securities, deposits and loans which are agreed upon by lenders and borrowers are examples of cash instruments. Number 2, derivative instruments. If the value and characteristics of a financial instrument is based on the vehicle's components like assets, indices or interest rates, they are termed as derivative instruments. An equity options contract is a good example of derivative instruments as the underlying stock derives its value. Over-the-counter or exchange traded derivatives is another good example where the securities which are not listed in any exchange formally are traded and priced. According to the asset classes, financial instruments are classified as number 1, debt-based financial instruments. These are further divided into two parts: short-term debt-based and long-term debt-based financial instruments. Short-term debt-based financial instruments are the securities that comes in the form of commercial paper or T-bills and deposits and certificates of deposits in the form of cash and also interest rate futures as exchange traded derivatives, which last for not more than an year. Long-term debt-based financial instruments are the bonds as securities, loans as cash equivalents and bonds as exchange traded derivatives, which last for more than a year. Interest rate swaps, interest rate floors and caps, interest rate options and exotic derivatives are the OTC derivatives in long-term debt-based financial instruments. Number 2, equity based financial instruments. It comprises of stocks as securities, stock options and equity future as exchange traded derivatives and stock options and exotic derivatives as OTC derivatives. Number 3, foreign exchange instruments. Third type of unique financial instrument is foreign exchange instrument. Under foreign exchange, there are no securities and according to the current prevailing rate, cash equivalents come in spot foreign exchange. Foreign exchange options, foreign exchange swaps and outright forwards are the OTC derivatives in foreign exchange instruments. Now, let us talk about the factors affecting international investment. In general, companies choose to invest in foreign markets on the basis of business needs and overall strategy, which influences purchasing goods and services and local market investment decisions. When a company decides to set up facilities for producing or marketing their products or seeking partnerships, investments or purchasing a local company for accessing and controlling the local market, resources and production, direct investment occurs in a country. The various factors affecting a decision of a company for international investing are: number 1, cost is the production in the local market is cheaper than elsewhere. Number 2, market. Has the identification of a local market is done by the company? Number 3, logistics. If the transportation costs are significant, is it cheaper to produce locally? Number 4, know-how. Does accessing local technology or business process knowledge is what the company wants? Number 5, natural resources. Does obtaining access to local resources or commodities are something which interests the company? Number 6, policy. Does government policies and political factors encourages FIIs and FDIs for providing the movement of foreign capital into the country? Number 7, customers and competitors. Does clients and competitors of the company operates in the country? Number 8, ease. Does setting up operations and investing in the country is relatively straightforward in comparison to setting up in any other country? Number 9, culture. Does company needs can be met with the skills of their workforce or labor pool, or is there a requirement for extensive training? Number 10, rate of interest. Does the interest rate in foreign country is higher than the interest rate in the native country? 11, profitability. Is the return on investment is high enough to scale up the profitability? Number 12, efficiency. Is the labor cost cheap enough to derive a lower cost of production? Number 13, impact. How does company's profitability and revenue will get impacted with the given investment? Number 14, expatriation of funds. Is taking profits out of the country easy considering local restrictions, if any? Number 15, exit. Does exiting from a local investment easily and orderly possible considering the local laws and regulations? Now, let us talk about the reasons for investing in international investments. There are two major reasons for people to invest internationally and in international exposure. Number 1, diversification. To spread the investments among foreign companies and markets in addition to the native markets and companies international investments plays a vital role. Number 2, growth. To take advantage of the growth potential in some foreign companies, usually in emerging markets, international investments are important. Risks involved in international investments. There are various risks associated with international investments, and some of the major risks are: the companies outside the native country may not provide investors with same type of information as provided by the native companies, and information may not be available in preferred languages. In comparison to investing in native companies, international investment can be more expensive. It is important for investors to make sure that they are working with registered brokers or investment advisors with appropriate state regulatory entity to have some sort of protection for their investments. Investment returns fluctuate according to the currency exchange rate of the country we have invested into, as it can increase or decrease the value of return on investments. Also, there are some countries that may impose foreign currency control, which restricts or delays the currency movement out of a country for the company invested in or the investors. There is a chance for investors to experience drastic changes in the market value for all securities markets, which includes markets outside a given country. Understanding economic, social and political influences on a foreign market is difficult for an investor and hence risky. Difference in the liquidity levels of outside market is a challenge for investors, as foreign markets may have lower trading volumes and there can be restrictions on the amount and type of stocks that investors can purchase. Having legal problems with foreign investments are difficult to deal with for investors, as they may not be able to seek certain legal remedies in the invested country and will have to depend upon the legal remedies available in their native country, if any. Difference in market operations in foreign market is another major concern and a risk for investors. Calculating international investment. In international investments, it is required to calculate the value of net foreign investments, which is also referred as net capital outflow from the economy, and it is the difference between the net investment made by local investors in the overseas economy and net investments made by foreign investors in the domestic economy. That is, NFI is equal to net investment outflow minus net investment inflow. Ways of international investments and examples. Major international investments depend upon the foreign direct investments, which can take place in the following ways. Number 1, acquisitions and mergers. This can be viewed as a foreign direct investment from one country to another, where a large company based in one country acquires another small company having its operation in a different country. Number 2, joint ventures. If a company in one country comes together with another company in a different country to carry out a business in one of the countries, it can be viewed as a foreign direct investment. Number 3, manufacturing. If a company in one country builds a manufacturing unit or factory in another country, it can be viewed as foreign direct investment. Number 4, facilities. If a company in one country builds and operates a data center in another country, it can be viewed as foreign direct investment. Number 5, horizontals. If a company replicates its business operations model in another country, which includes administration, logistics, sourcing and data center, it can be viewed as a foreign direct investment. Number 6, verticals. If a company strengthens a part of its supply chain by entering a foreign economy without changing the business model in any way, it can be viewed as foreign direct investments. Number 7, conglomerates. If a company invests in a foreign country by buying an entity manufacturing totally different products from its existing business to start new journey by adding more niches, it can be viewed as a foreign direct investment. Some significant examples of international investments made across the globe are: in recent years, Indian economy has seen a tremendous inrush of foreign direct investments. In 2013-14, foreign direct investments grew to $36 billion from $17 billion, which majorly attributed to better ease in doing business along with strengthening the Indian equity market. During the period of 2015 to 17, foreign direct investments from Asia reduced, which was large due to the tax related treaty between Mauritius and Indian governments, resulted in a remarkable decline of 30%. During the global recession period of 2009, foreign direct investments were reduced by over 1/3, which was recovered back in 2010. According to the data presented in the World Investment Report, India has received over 51 billion USD as FDI in 2019 across various sectors including education, technology, automobile, telecom, pharmaceuticals, textiles, etc. The major contributors for FDI in India include countries such as Singapore, USA, Japan, Mauritius and Netherlands. Recently in 2020, some of the major startups and companies have raised handsome amounts in forms of FDIs such as Byju's, an online edtech firm raised USD 500 million in Silver Lake led funding. Unacademy, which is another online edtech firm, raised USD 150 million from SoftBank Group of Japan. Google have picked up nearly 8% of Reliance Jio platforms for USD 4.5 million, which is one of the biggest deals in recent Indian corporate fundraising. Advantages of international investments. Number 1, boosting the local industries and stimulating the country's economy can be considered as major benefit of international investments. Number 2, creation of new job opportunities, which leads to the rise in purchasing power and increase in the standard of living of the people of the country, is yet another leading point of international investments. Number 3, international investment provide access to opportunities that exist in different markets and opportunities that indigenous markets may not provide. Number 4, international investments may guarantee greater gains to providing access to financial instruments that allows negating the risk associated with currency exchange. Number 5. Investments for getting additional expertise, products and technology would also provided by the parent enterprises. Number 6. International investment is an opportunity for an investor to diversify portfolio, getting entry into the new market and expanding the business, etc. Number 7. It benefits investors through the medium of tax incentives. Number 8. It helps in reducing the cost of production. Let us now discuss about the disadvantages of international investments. Number 1. By creating huge competitions, international investments can make things tough for local companies. Number 2. Any kind of changes occurring due to political conditions can lead to expropriation, which is always a big concern for investors investing internationally. Number 3. Investments can become economically non-viable due to instability in economic conditions. Number 4. Things can become worse for investors or the target economy when international investments impact exchange rates. Number 5. International investments involve risk of non-availability and non-accessibility of vital information related to foreign markets and firms, which is a big concern for investors. Number 6. Varying operating conditions and legislations of foreign markets are responsible for rendering the complications associated in international investments. We will continue with this topic in the next session. So, that is all for today. Hope you have understood. We will meet in the next episode with a new topic to take understanding of international financial environment at a deeper level. Till then, take care. Goodbye.